It's no surprise to any of us that our country's economies are closely interlinked and dependent on each other more and more. This was already how it was during the Great Depression almost 100 years ago, and the consequences of a similar event was already seen firsthand during the global recession in 2008. However, what if we haven't seen the worst of it yet? As instabilities in the market show up more and more, are we due for an absolutely catastrophic crash? Today, we'll take a detailed and informed look at that, and what some of the world's richest people think will happen. Before we start though, make sure to subscribe to our channel and click the notification bell for new updates. Done that? Let's get into it. The world economy, also known as the global economy, refers to the global economic system, which includes all economic activities carried out both within and between countries, such as production, consumption, economic management, and work in general, including the exchange of financial values and the trade of goods and services. A stock market, on the other hand, is a gathering of buyers and sellers of stocks, also known as shares, which represent ownership claims on businesses. These can include securities listed on a public stock exchange, as well as private stock, such as shares of private companies sold to investors through equity crowdfunding platforms. The most prevalent ways to invest in the stock market are through stockbrokers and computerized trading platforms. Stocks and the buying and selling of them comprise a large portion of global economic activity. A stock market crash occurs when stock prices drop dramatically throughout a large segment of the market, resulting in massive loss of paper wealth. Panic selling and underlying economic causes then result in crashes. It is a social phenomenon that occurs when external economic events mix with crowd psychology to create a positive feedback loop in which some market participants sell, prompting additional market participants to sell. In general, crashes occur when there is a protracted period of increasing stock prices, a bull market, and excessive economic optimism, a market where price-earnings ratios surpass long-term averages, and market players employ a lot of margin debt and leverage. A stock market crash has no precise definition, although it is often defined as a drop of more than 10% in a stock market index over a period of several days. Because crashes entail panic selling and fast, severe price falls, they are frequently separated from bear markets, which are the periods of dropping stock market values measured in months or years. The stock market plays a persistent role in our daily lives, whether we know it or not. Consumers frequently spend more during bull markets because they benefit more from the impacts of a robust economy and feel wealthier as their portfolios increase in value. During bear markets, the company normally does not perform as well as it should, and spending falls. A drop in stock prices at the same time raises concern about the loss of wealth and buying power as the value of assets declines. A rising stock market generally corresponds to an expanding economy and boosts investor confidence. Investor trust in equities leads to increased buying activity, which can aid price rise. People who invest in the stock market acquire riches as the stock market rises. Changes in the stock market can have a variety of consequences for businesses. The market capitalization, and hence the market worth of a firm, are affected by the increase and decrease of share prices. In terms of market value, the greater a company's stock price is, the more it is worth, and vice versa. When contemplating mergers and acquisitions that include stock as part of the deal, a company's market value might be essential. The performance of the stock market has an impact on a company's cost of capital. Businesses must aggregate the expenses of both loan and equity capital when determining a weighted average cost of capital. This figure is employed in numerous study situations. The cost of equity capital will grow in lockstep with market expectations. Stock market collapses wipe out equity investment values, and the immediate losers are individuals who rely on investment returns for retirement. Although stock market collapses might last a day or a year, they are frequently followed by a recession or depression. Other than that, you might lose your life savings, your firm could be unable to pay workers, and so on in extreme instances. In the worst-case situation, key services and commodities may be unavailable due to a lack of resources and the inability to pay personnel. Unemployment, starvation, and the failure of critical social services are all consequences of such a vicious cycle. The year 2022 has started off as a difficult one for investors. The first week of the new year began with a significant bond market fall, followed by a significant stock market correction. While no one can foresee big collapses with 100% accuracy, an increasing number of indications and patterns indicate that the stock market downturn is just getting started. Fundamentally, there is a growing body of evidence indicating the global economy is slowing rapidly. Global equities fell to their lowest levels in almost a year, owing to huge losses in Netflix stock, which exacerbated a sell-off in internet companies that spread to other sectors. As the Federal Reserve tightens banking conditions, investors have fled speculative areas of the market. Shares have plummeted in the United States, where many of last year's high-flying IT companies are listed. Over the second week of January, the blue-chip S&P 500 index, a widely watched indicator of the $50 trillion US stock market, has lost 5 to 7%. More than two-thirds of the businesses in the index are now in a technical correction, meaning they are down at least 10% from their all-time high, with 149 equities down 20% or more. Some kind of contagion from tech to the rest was inevitable at some point, said Luca Paolini, chief strategist at Pictet Asset Management. When you have these kinds of losses, they affect sentiment, and everything else goes down. Europe's stock markets also plummeted, with the Stoxx 600 equity index losing 1.4% for the week, its third weekly loss in a row. Predicting macroeconomics is challenging, to say the least. My gut feel is maybe around spring or summer 2022, but not later than 2023, Musk tweeted during the start of the month. This tweet was a follow-up to a response to his initial tweet in which he wrote, "If history is any guide, not many will make it past the next recession. Clearly the future is full of gloom in the eyes of Musk." He has not explained his reasoning, however. In a shareholders' meeting in 2021, Warren Buffett said, "In my view, for most people, the best thing to do is owning the S&P 500 index fund. If you bet on America and sustain that position for decades, you'd do far better than buying treasury securities or far better than following people. Perhaps with a bias, I don't believe anyone knows what the market is going to do tomorrow, next week, next month, next year." While he's not outright signaling that the market will crash, some of his other rhetoric and tone in speech has been indicative of such a thought. These two billionaires have, however, merely joined Bill Gates in such a prediction, who made it back in 2018. When asked if the United States will face another catastrophe like the one in 2008 during a Reddit Ask Me Anything session in 2018, Gates said bluntly, "Yes, it is hard to say when, but this is a certainty." In November 2019, the current bull market set new marks for being the longest running and best performing since World War II. In early 2020, there was a brief market meltdown known as the coronavirus crash. By early April, it had been forgotten, and the bull run had continued through a global epidemic, a tumultuous election season, the second impeachment of a president, and a mob takeover of the US Capitol. The cyclically adjusted price-to-earnings ratio, or CAPE, is a variant of the price-to-earnings ratio formula, and it's also known as the Shiller P/E ratio, or P/E10. It compares a stock's current price to its 10-year mean actual profits per share, adjusted for inflation. This smooths out the market's gyrations, allegedly providing a more realistic picture of whether a stock is overpriced or undervalued, based on its actual performance over time. The CAPE ratio appears to have precisely forecast the Great Crash of 1929 and the dot-com crash in hindsight. Even if it did, there is no concrete trading rules that can be built from the CAPE value that can advise investors exactly when to buy or sell. It might turn out to be correct once more, or maybe not. The Great Crash of 1929 is most known for two consecutive trading days, October the 28th and 29th, 1929, when stock values plummeted by 13% and 12%, respectively, on Black Monday and Black Tuesday. But this was just the most dramatic incident of a longer-term bad market. Although economists couldn't blame the Great Crash on the increasing CAPE ratio in 1929, the arguments cited at the time and today were fair. Stock prices reached unsustainable heights due to irrational investor euphoria. They believed the economic expansion would go indefinitely. The most daring investors took a risk and bought on margin. Intriguingly, low interest rates encouraged speculation by making borrowing cheap. One of the elements contributing to the commencement of the Great Depression in the 1930s is the Great Crash. Concerned about stock market speculation, the Federal Reserve tightened its monetary policy severely beginning in 1928. The Fed evidently believed that by doing so, it would be able to moderate speculation while not causing too much damage to the markets as a whole. Instead, a recent Fed research found that it may have played a role in the Great Crash. Worse, the Fed tightened monetary policy following the crash, extending and exacerbating the financial crisis. Furthermore, the Federal Reserve began withholding credit to banks that gave loans to stock speculators in 1929. The Fed found that stock market speculation diverted money away from constructive applications that benefited American industry and trade. Following the financial crisis of 2008, the Federal Reserve, led by Chairman Ben Bernanke, embarked on an aggressively expansionist monetary policy, aimed at bolstering the financial system, securities markets, and the broader economy. Quantitative easing is a policy that relies on the buying of large amounts of government bonds in order to lower interest rates to near zero. Meanwhile, Greenspan is among many who now claim that the Fed produced fresh financial asset bubbles by prolonging its cheap money policy for years after the 2008 crisis was resolved. It's really hard to foresee how the next crash would unfold, as Gates indicated. However, it's easy to see how history is being set up to repeat. That is all for today, our dear viewers. Let us know what you think about the fears of an upcoming stock market crash in the comments below. Remember to like this video, subscribe to our channel, and click the notification bell to receive new updates. As always, thank you for watching, and we'll see you again next time.